All right, welcome back, guys. So we're going to summarize what we've learned today as far as the accounting equation. The accounting equation says my assets equals my liabilities plus equity. In order for this to work, we need to understand what we mean by assets. We need to understand what we mean by liabilities. And we need to understand what we mean by equity. And then revenues or gains. And we need to understand expenses or losses. So I am going to explain this in terms of the accounting equation. Okay? To be able to do that, we are going to draw a line. We're going to call this side debits. We're going to call this side credits. So what we're going to do is we're going to define each of these terminology, give examples of them, and then we're going to tell you how do we record it in terms of debits and credit. So the formal definition of an asset is a right to economic benefits. Examples of assets will be buildings, cars, furniture, laptop, computers, projectors. I think people are assets, but my paper has been published, and if you Google my name up, you're going to find my paper, and I explain to you why people are assets. But for the purposes of this class, we are not going to say people are assets. Does that make sense? So we know what an asset is. When an asset increases, we call that debit. When it decreases, we call that credit. Does that make sense? Right. An increase in an asset is called debit. A decrease in an asset is called credit. Debits and credit are Italian words that we're going to borrow and use it throughout accounting. You can also use increase or decrease if you like. Okay? Now, a liability is an obligation to transfer economic benefits. That's the formal definition of a liability. An obligation to transfer economic benefits. Example, a bank loan. I have an obligation to pay the bank. Another example, a mortgage loan. I have to pay my mortgage. Rent accrued. I've stayed in an apartment. I haven't paid my rent. That's accrued. Accounts payable. All those are liabilities. When a liability increases, we call that credit. And when it decreases, we call that debit. And the same thing for equity. Equity, liabilities, and revenues are friends. You can see that when they decrease, we call that debit. When they increase, we call that credit. Equity is simply the difference between assets and liabilities. Or it is the capital that you've introduced into the business, plus your retained earnings and other ownership transactions. That's what equity is. Does that make sense? It's the owner's interest in the business. We call that equity. And a revenue is money from your primary or central activities. So if you're a car dealership and you sell cars, the revenue is from selling cars. But if you take the money that you got from selling cars and you invest it, you get investment income, we're not going to call that revenue. It is just an investment gain or loss. Does that make sense? So revenue is money from primary or central activities. Expense means expired cost. As you use assets, as you use liabilities, you generate expenses. When you use a car, we call it depreciation expense. You use a building, it's depreciation expense. You use people, you pay them salaries, expenses, right? And when you use somebody's borrowed money, you pay them interest expense, right? And so when an expense increases, we call that debit. When it decreases, we call it what? Credit. You realize that assets and expenses behave the same way in terms of debits and credit, and the rest of them behave the opposite way in terms of debits and credit. Does that make sense? So, in summary, if I say my friend Ali, asset equals liabilities plus equity. Ali came with me and she said that she put $100 in the business and her total assets is $150. Then how much money did Ali borrow? That's your homework. Make sure you pass the test, okay? That's your homework. If my friend Ali told me that she started a business with $100, but her total cash is $150, she must have borrowed money from somewhere. How much is that? Easy peasy, guys, right?